Hi, this is Shane with the Rational Hitter. It is Monday, the 8th of April. I'm just back from vacation, and I have implemented the choice I made based upon the experiment we were finishing up in March. So let's review that real quick. What we were doing in March is basically described by this diagram, which says find the most clearest signal, the clearest signal over the last 5 weeks, and apply that going forward. And that is, I ran that on gold and CL. It did okay on CL. It didn't do. I wouldn't say it did well. You didn't lose a lot, but you never really caught decent trades. In gold, it did terrible. I lost. I was hitting several max loss days. So in general, that idea, which logically seems sound, does not pan out in real conditions. And instead, we've been using this method, which is take a model that I've built with data. In this case, this shows June, but now it's really through the end of September, and then use that model and to analyze predictions on the data that then came next. All right, so we go back 6 months, build a model using data only through September, and then run that model to get predictions from it on data it's never seen before. And then we analyze that output. That also makes logical sense, and that's what we started with back in December, which did quite well actually in CL at the time. Now, having decided that this clearest signal method doesn't work, we're switching back to this, what I would call the predictive method, the predictive analytical method. The problem that we had here is what we found is that we weren't taking a lot of trades, but we're taking more than we want, particularly if you're going to trade multiple markets. It starts to add up quickly if you're trading 4 markets, even if you're taking just a trade or 2 a day, but you're not, what we're doing is taking a very defensive posture and then getting that nice big trade when it comes along. It has to come along often enough to warrant all the little gains and little loss days that you take, given the commissions and other fees that you have to pay. All right, and so one of the things that I found is that, okay, this is taking more trades than I'm willing to do if I'm going to trade multiple markets. All right, and so what I did is I've implemented this approach for all markets. So that's gold, CL, 6J, which is the yen, and then the overnight, the London session, and the U.S. session for the euro. Now, I made 2 changes. One was aimed at reducing the number of signals the machine would find, and we do that by simply telling the machine that I require a longer run before you can consider that a good bar to analyze for patterns. So, for example, let's take I think gold had some nice runs today. Let's take the gold market. If I told the system, show me a run that's say 20 ticks long, then it would it's going to find all of these in here as potential trades, which is a lot of noise. You want to stay away from that. If, on the other hand, I tell it, show me runs that are this long, well, then the system's only going to find fewer of them. In other words, the patterns that match to that behavior are going to be fewer. Okay. And as a result, the expectation is that you take fewer trades. Now, we've seen that historically in the NASDAQ, so we know that that's an effective way to take fewer trades. I also have a way to quantify how I'm measuring the, I don't want to say the amount of fewer trades, but the sort of the progressive severity of it. Okay, and so what I've done is I've taken one step. I've gone one step up from the norm and implemented that in all of these markets. The next thing I did was some analysis that's aimed at someone who wants to trade all four markets. Okay, so someone who wants to trade all four markets is interested in a fewer number of trades to give themselves less exposure to getting churned to death with lots of fees and commissions. Okay, and so we'll talk about the people that are trading a single market in a moment. But to do that, what I did was in my analysis here, I was aiming for something different than I had been in the past. So these are stacked. This is just an image I snapped off the development computer. I can find the cursor that shows 1, 2, 3, 4, 5 different end analytical runs for five different markets, or it's actually 4 markets. It's the 6E is listed twice, once for the London session and once for the U.S. session. Okay, and what we're previously I would look at things like I lost my mouse again. Things like total profit against risk. Okay. And that would be the thing that would govern whether I would be interested in that set of behaviors to trade in that market. Let me change the color of this pen. Can I go? And now, in this case, I'm looking at something different. I'm looking at the trades per day and with the ER, which is really the trade quality. All right. And so these are the 2 key factors I'm looking at. And what you'll notice in all of them is that the trades per day are all about in the range of 3/4. So 3/4 of a trade per day, 3 to 4 trades a week is what the system's been seeing. So keep in mind now, we're not back testing where you take an algorithm and apply it to past data and show how awesome you are. We're actually taking a model that was built with data through this time period, and then we applied it to data, to actual trading action that the model's never seen, right? And then we took the output, and then we ran a simulation that said, okay, if I was running this model on what actually happened, what would, and I took these signals, what would the result have been? And then we analyzed the best ones, and those are the ones that are the patterns that are clearest for that market. They're different for each market. All right, and then what I want to do is as I do that analysis, I can pick and choose the different behaviors, which are represented by these codes here. Okay, short codes and long codes. Members will know what this is. Okay. And then we plug in those codes, and then what that means is if for this is the GC here. For GC, if I'm using these codes, I have a very clear, very quantifiable understanding of the number of trades I expect to take per day on average, and the quality of those trades. Okay, this is basically ticks per trade is what that works out to. And what we want is we want to put ourselves into a position to get a nice run and then let the market work for us is what we're after. So we want this number, higher than 4, fairly high. The higher the better. What you'll find is that the higher you go, the fewer trades you get. So it becomes somewhat problematic to do something on a regular basis if you're only requiring grand slams on a blue moon. So this is where we stand now, and this is what I'm burning in. I've already found one sort of error in my setup, so this is why we test. And so I'm very curious now to see, given these settings, given this setup, how well do I do in terms of with real data, the model built with data through last Friday, or in this case, it's the Friday before because I was on vacation. how well will this perform now in total, not on a daily basis. I actually don't care what happens in a market in a day, in a day, or even how all the markets work out in a day. I just kind of want to look at it at the end of the day and at the end of the week and see where we stand. I'm really less interested in what movement occurred. I don't care. I'm not even looking at it. I'm just looking at data. Okay, and so I'm burning this in live this week and working through any issues, and then I will release this out to members probably this coming weekend, though it is tax time, so it might push to next weekend because Uncle Sam wants his money. If you were trading just a single market, you would not want to take this approach, because you would be, let's take oil for example. You'd be looking at 0.63 trades per day. That's what, 3 trades a week. It's probably not enough, and this is an average of a prediction. So what's actually going to happen there'll be there's error bars around that, but it shouldn't be a lot. And that's probably not what you're after if you're trading a single market. So I will put out a different set of analyses that go back and use things like profit versus risk factor as a way for those folks that want to trade a single market. But what I'm trying to do here specifically is trade basically as many markets as I can as a way to smooth out the bumps and mitigate the risk. And the conclusion I'm coming to is that I need to be a little bit choosier, and I know how to do that. And so that's what I'm implementing here now. We have to burn this in live now and see how it behaves. And then if I need to get even choosier, I can. If I need to get less choosy, I can do that as well. I've got lots of knobs I can turn. They're not necessarily easy knobs to turn because we're dealing with changes to the model architecture and changes to the way the data is presented to it. So it's somewhat laborious, would be a very generous way to put it, to make this kind of change. And as a result, we want to, we think very carefully about what we want to do before we're willing to do it, because it's a big time. It's a very large time and human time commitment as well as computer time commitment to create the models and then do the analysis. All right. So with that in mind, my result for today was I took no trades in 6E overnight or during the U.S. session. In fact, we spent most of the time outside the value area, though these pullbacks to these low volume nodes are candidates for entries. You can see that's exactly where you want to be looking, but no signals there. And then once the euro opens, we got to switch over to the. Am I looking at the right one? .6L. I looked at the wrong one. So in any case, one chart is set up for overnight action, starting with the London session. So starting right here, and looking for trades. So the volume profile is different. The way the order flow is different overnight versus during the U.S. session, and so I end up running 2 different models. So I didn't get a signal there, and I didn't get a signal here, even though this market made a nice up move. And then, so 0 there. And then in the yen, I got a signal here to get long on a 141. That's a break of the high, or break of that previous wave high. But didn't get filled for that little move. And then in gold, there were no trades. The gold also had some nice moves. Here's the gold open. Gold popped higher and then thrashed a bit before it rolled over. So there's some opportunity there. I'm looking for very specific behaviors. So I'm not coming in and looking at what you. I'm specifically trying to avoid the trap of looking at the market and going, oh, I want to get this move right here, and because of that, I'm going to add a 174 short, and I'm going to be super happy, and life is good, and birds are tying bows in my hair. That's not what we're doing here. We're looking for, I hate to use the word consistent, but we're looking for behaviors, which is price action and order flow, that have shown predictability in the past for a good trade. All right, and then in oil, I took one trade and scratch, so I got long right there on this 174, got just enough to get to scratch, and then got taken out. Let's look at this to see if I would have survived my too tight trail. All of these markets are trailing by 20 ticks, and they're all moving stops at entry plus 10 to entry plus 1, and then just letting it go, trailing by 20. In this case, this is trailing, but the stop on oil is 7. 1, 2, 3, 4, 5, 6, 7. I already got stopped out to the tick and been pretty hurt, pretty painful. I'm just curious because there's a nice move there. Pay no attention to the coughing child in the background. Yes. Okay. So I make a scratch out here, make one tick in oil, and then we spend a lot of time outside the value area, which I'm not chasing at this point. We were analyzing the outside value, the outside the value area earlier. We're gonna put that away for the moment and come back to it. The market pulls back down here, and there's opportunity here to get in. You can see the codes being listed out, but no other trades for me in oil. So I like what I see in that respect. 2 attempts across 4 markets in one day. One did not get filled. One scratched for 1 tick. Okay, I'm satisfied with that. Let's see what happens over time. Okay, what I don't want to see is what gold was doing to me the last couple of weeks of that experiment, where I was expecting very few trades. And it was giving me a ton of them and bearing me a lot. So clearly, that approach, there's a flaw in the logic that suggests that. Nice silence to coughing here. Clearly, there's a flaw in that approach that. I don't. There's something I don't understand, or just my logic is messed up. In any case, we're working through, trying to find that sweet spot of trades versus the number of trades versus trade quality over time, spread across all markets traded. Understanding that. They're not necessarily the same. I may have a different tweak for the 6E than I have for CL for GC. So we'll work that out over time here. And then for members, when I publish this to you, you'll get a different set of codes if you want to trade just a single market, right? That will give you, and with the same understanding of what the risks are. Again, it should be choosier because the model itself is choosier. But we'll give you more looks at the basket than what I'm doing right here will. Okay, so you have that to look forward to. Take care.